Have you ever wanted to get involved in real estate development, but didn't know where to begin? Do you think real estate development is only for the large hedge funds or major corporations, the big guys? Or have you done some development in the past and are looking to scale up? If you answered yes to any of these questions, then this podcast is for you. Welcome to the W.I.R.E.D Wealth and Real Estate Development Podcast. I am your host, Nick Smith. Get ready to have your mind blown and rewired as we discuss all aspects of creating wealth and real estate development. Good day, everyone. This is Wealth and Real Estate Development. I am your host, Nick Smith. This is episode 14. I definitely want to thank you all for tuning in. We're in for a treat for sure, but if you are getting value out of these episodes, I definitely do ask that you like, subscribe, share these episodes. It will definitely help me get this message out, get the word out. We are here to help build wealthy communities, wealthy families, and wealthy individuals through real estate development. So today we have a very special guest. His name is Bryan McCloskey. Did I say your last name right? As much as I've said it.
You got it.
Bryan McCloskey. And I've practiced his name because I've known this guy for about 6 or 7 years now. And I've said it many times in my head. I never really said it out loud.
Once we have the live audience and we have someone watching, then the pressure's on. Is it Klosky? I've gotten all different type of versions of it, but I know everybody means the best by it, so it's all good. Bryan McCloskey. It's good to be with you, Nick.
Definitely. Bryan is a wealth strategist with Paradigm Life, and we're going to get into his background and how he and I actually got connected. But Bryan, welcome, sir. How are you?
It's just really happy to be here. I love what you're building, including the visual behind you. Like it represents what you're building. But just honored to be on here and definitely want to help you share some insights with your audience.
Good deal. Well, man, if you can, give my audience a little background of who you are, where you're from, what you're doing, and what your mission is.
Got it. Yeah. Born and raised in Philadelphia. And
Philly.
Yeah, Philly boy. So Eagles, Phillies are actually doing something right now. And it's just fun to play. The Sixers are a debacle, and the Flyers aren't even on the map right now. But it's just born and raised in Philly, and I got connected with some of the ideas we're talking about today randomly when I was in my early 30s. So you guys, there's a little gray hair and a little less hair up here, so I'm not going to put the actual age on it. But a number of years ago when I was in my early 30s, I heard about some of these ideas. First of all, I was a teacher by trade at the time, didn't even own my own house, started to hear that real estate was a way to build some wealth, and then also started to hear that I could hold my capital and be my own bank. And it was really a conglomeration of these two ideas coming into my world right around the same time that basically took me on a different trajectory. And fast forward to today, I've been honored to do some incredible work with folks across the country when it comes to building their own bank. And then also I've had some success in the real estate world with myself and kind of been alongside some clients when they've done it as well. So your podcast speaks to me, and what you and I have talked about offline, what you're doing and building speaks to me. It's very inspirational. So that's my story. I'm sticking to it. And I think that's where we're going to plug in.
Good deal, man. Good deal. I do want to just kind of let everybody know how Bryan and I got connected. I'm a big podcast listener. I think if you're going to start a podcast, you should also listen to podcasts. So I'm a big podcast listener, and it's been several years ago. Now it's probably been about six plus years ago. I heard this guy named Patrick Donahoe on the Bigger Pockets podcast. And for those that don't know, Bigger Pockets is like one of the biggest real estate investing, financial literacy podcasts that are out there. So heard this guy, Patrick Donahoe on there being interviewed, and his company was Paradigm Life. And we're going to get into it with Bryan, but he talked about becoming your own bank and utilizing life insurance to facilitate that. And definitely caught my attention. At this time, I again was around Bryan's age. I was in my early 30s. I'm in my late 30s now. I was in my early 30s, and it caught my attention. So, of course, I'm an adventurous soul at times. So they said, go to the website. And when you went to the website, they have this link where you can fill in your information, and somebody will reach out to you and somebody will contact you. And lo and behold, this is where Bryan steps in. He's the one that contacted me, and he's been a valuable resource, to say the least, during that time, because and this what showed me the type of character that he had while we were working through, because for one, he took me through a series of interviews to even see if this was a right fit for me.
Sure.
But he may not even remember this, but during that time, as we were going through those interviews, I totaled my car. I totaled a car. And so I'm sitting there like, I'm a realtor. I got to have a car. And he pretty much stopped the whole process and was like, okay, wait a minute. We got to bag up. You got to get some wheels. Those are his exact words. He said, you got to get some wheels. And that spoke to the character. It wasn't about just me becoming a client of his. It was about, he was really looking out for the best interest of me. So I definitely appreciate that. But Bryan, can you get into just kind of the basics of some of the things that we talked about in the initial phases as you were explaining it to me? How does one start creating their own bank?
Certainly. And actually you are bringing back memories of having that happen. And I'll give a little flavor to why I encourage you to tackle the fire that was in front of you, so to speak, like tackle the problem that was in front of you and not build your policy just yet. It's not just because from an integrity standpoint, but these assets, where I'm going here in a second, these assets, this becoming your own banker thing. So this is the book that turned me on to this well before Patrick even wrote his book, but becoming your own banker. This talks about using life insurance policies as a place for capital that you can then strategically turn into a family bank. And as a real estate investor, have an additional funding source for deals. But I'm sure we'll get into that. But this is like one of the, I hesitate to call it, I'll call it this, but just understand I'm not disrespecting the Bible. This is like the Bible about it, right? This is like the Bible about the whole concept, and it's very well worth reading. I've multiple iterations of this on the shelf as I've done it, and I share it with folks.
And for those that aren't watching, he just held up Nelson Nash's book called "Becoming Your Own Banker."
That's right. We are on a podcast. Thank you for reminding me.
Nelson Nash's book, and I've read that book. This is pretty much the holy grail of infinite banking concept.
I love that word better. Even better, it's the holy grail. That's right. Becoming Your Own Banker by Nelson Nash is just it gets you into it. And granted, some of the numbers are older, from the late 90s and early 2000s, but it's still incredibly relevant. And then Patrick wrote a book, Heads I Win, Tails You Lose, which you can learn more about, I'm sure, on Amazon and/or at paradigmlife.net, which is a very good synopsis of not just how the concept works, but then also how you can apply it to retirement and how you can apply it to purchasing some other assets. He talks about the hierarchy of wealth, where real estate comes into that world, especially real estate we can control and cash flow from. So I've heard about these things, and as I get into I bought my first policy in 2006 before I got into the industry. And I read enough. I was like, just kind of like you, I was like, I'm going to blaze this trail. It's a little bit different. And this is where I'm going to hold some cash for my family. And it was a little bit of a stretch for me. And it wasn't even built as efficiently as you're familiar with now, Nicholas, how we can build policies where they have cash value out of the gate. Mine was one of the old school policies that doesn't even have cash value for like the first 2 years. So I was really expecting or really hitching my ride to this horse, so to speak, and waiting. But fast forward a couple of years, that effectively I started to see how this thing works. And I started to see that this was a great place for capital. And I started to be able to borrow against it when necessary. And the things that I was learning about were starting to become real. I actually used it for a down payment and to buy a contract off a wholesaler to get into a property in Philly. So I started to do these things, and I was like, man, this thing really works. And then I got into the industry. I learned how they work better. I can get paid now to help people set it up, but I also learned how to make more cash value show up early. Mm-hmm. But I'm coming back to your story here. As great as these accounts can be, personally and professionally, I think everybody should know about them. Almost everybody should implement them. There's reasons not to. One of those reasons could be cash flow and making sure with a strong expectation that we have the ability to feed our policy for at least a few years. Here's why. Because just like very similar to a business, many businesses fail within the first few years if they don't do it. And it takes a lot of work and capital and effort to really build a good business and fight through those first couple of years. A life insurance policy is kind of like a business. It could become a funding arm or funding business within your real estate investment world or even within your family world. But if you don't feed it well in the first couple of years, it could go away. And there are costs that are overcome within a couple of years, but there are costs you could incur. And then that's if that happens, someone then has a bad taste about whole life, and then they may never do it ever again. And what I don't want anybody to have is a bad taste about such a very good asset. So like thinking back to your situation, or even anybody in the beginning, like there are some people that I say, let's not do this now, or let's wait until things are a little better, because we got to be able to feed this thing for a few years and make sure it makes sense. And then as you've recognized by now, once you have it up and running, it becomes a dependable thing. It doesn't require as much cash flow if you build it a certain way.
Right.
Tenants and real estate projects can fill it, that sort of thing. But I wanted to speak to, my thoughts on what you had said there about like, when you learn about this, it could make sense to start one, but it also could make sense that you're setting the stage to start one, a little bit further in the future when the cash flow is better, if that makes sense. I was trying to switch a couple things together for you.
Gotcha. No. And on a high level, because I know we can't get into the full intricacies, so to speak, because I remember, again, the multiple Zoom calls that we had in the beginning, and you showed me just various graphs and things like that. How does this policy actually work? How is it structured? What allows you to become your own bank?
Man, that's some very good questions there. I'd say, first of all, you're definitely, for the audience members who are roughly familiar with life insurance, we're definitely talking for ultimate dependability. We're definitely talking about whole life insurance, because there's a couple different types that have cash value. But in this world, we're talking whole life because of the dependability of removing concerns about the policy being overtaken with costs in the long run. So we're definitely talking about whole life. And then secondly, we're talking about, yes, we are talking about life insurance, not just from a death benefit perspective, like a cover the mortgage perspective, but literally from a hold some cash perspective. And that's different, right? Like, so most folks just think, I got cash in the bank and I got money in my 401k. Or I got cash in the bank and I got money in this investment account. And for real estate investors, it's like I got cash in the bank. Hopefully, I got lines of credit, and then I have my property. So high level is thinking about a proven asset. I say proven. Accounts like this have been around for over 100 years. Accounts like this pay dividends on top of guaranteed growth. Accounts like this do not get wiped away when the market drops. Accounts like this historically pay a little bit better than bank accounts. And accounts like this, one of the most important pieces, accounts like this can be used and grow without incurring a tax liability. So you have an account that has a lot of those attributes that I just kind of talked through, and you kind of place it right next to your bank account, and you just start to hold capital differently. That second bucket of capital in the life insurance just happens to be wrapped inside life insurance. And there could be benefits to there that could play a role in the bigger picture. But then what you get the opportunity to do, it's a contractual right. You have the opportunity to borrow against the equity inside of that account, then against it's called cash value inside that account. And you have a contractual right to borrow against that. You don't have to do a credit check. You don't have to set up, payment plan right away. There is interest that's payable to the insurance company, but you can actually start to act as if this is your own bank by using this account and start to lend into your projects, and then have your projects pay back that plus the interest plus a little bit of capital to you, right? So you can really get into it, and that's kind of what Nelson Natch starts talking about. He has a whole chapter. I might refresh your memory, Nick, here in a second, but it's about the grocery store analogy with fees, right? It's painful, like to think that you would want to pay yourself market rate interest, if not a little bit more. And it's definitely painful if you're talking about using your bank to lend to a family member, whether it's a kid or a sibling or whatever, and charging them market rate or more, because they're thinking like, you're my brother, right? You're supposed to be giving this to me for free, but you're like, no. Nelson Natch talks about the opportunity costs of that and making sure we incur it. So there's a whole chapter that kind of stretches your brain about the peas, the can of peas in there, but in the grander scheme of things, you can start to leverage this and use it as your bank as time goes by. Last piece to highlight the leverage. I say leverage very specifically because it's just like a piece of real estate. It's very similar to real estate. Real estate, you can borrow against the equity of a property. Real estate, you can improve the equity of that property by fixing it up. Inside of a policy, you can borrow against the cash value. You can add to the cash value to increase your ability to borrow against. But what's very interesting is that, for the most part, there's some nuances here depending on what some of the contractual provisions are, depending on the company. But for the most part, the equity continues to grow with guaranteed growth in dividends, even when you're borrowing against it. And that's where you can truly leverage. You can have your capital held somewhere, still growing inside there while you're leveraging it to move it into a property, and then effectively have the property, whether it's through a refi or whether it's through a sale or whether it's through tenants, help you fill back up the bucket to then what? Rinse, repeat, sort of deal. Does that help a little bit?
No, definitely, 100%. That was one of the things that really attracted me to the product because at that time, I don't know if you remember this, but at that time, I had a term policy. It was like a 30-year term policy that I took out when I was in my 20s. I think I was at my first employer at that time. And, we were having the debate and the just going back and forth on whether to keep that term policy or not. And I did end up letting it go, is because one thing, with the term policy, for one, term is only good for a specific term, but it did not have the aspects that this properly designed whole life policy. I couldn't borrow against my term policy. I could not utilize that, to start initiating, just different facets of literally becoming your own bank. That wasn't, a factor in the term policy. So, that's what kind of led me, down this rabbit hole, down this path. Now, you mentioned the word guaranteed growth and even dividends. What type of returns on your money could one expect with these type of policies?
That's a great question. So historically, even in the low interest rate years, we tend to see like 4 to 5%, 4 to 4.5%, just underneath 5%. Mm-hmm. So it's really interesting, and that happens technically once you get into year 3 or 4 of what you see here. It happens inside the account, inside year 1, but it's a little harder to see. It takes some work to understand what's the mechanics. But 4 to 5%-ish, not taxed, is where I'm going to kind of like finish off that statement with. Because think about it. If you have right now, we can get 4 or 4.5% sometimes in our money market mutual funds or in some of our savings accounts while we're waiting for the next deal. That's fine, but and that's all good. There's nothing wrong with those accounts. They complement each other, but that's actually going to be taxed, right? When this policy is built and held and used the right way for a long time, you're not taxed on that. So that could conceivably be the equivalent of getting 6.5 to 7%, mm-hmm. Pre-tax equivalent. So that's typically what we see nowadays.
Gotcha.
With the policy.
And another aspect, because again, when I heard those returns, those returns are not just quote unquote sexy sounding, 4.5 to 5%. I mean, this is not double digit returns that we're talking. This is not 12, 15%. So it wasn't sexy. But again, as Bryan stated, this is tax free. And then not only that, when you factor in the eighth wonder of the world, compounding. Yep. As your interest start making interest, it just builds your policy that much faster and that much larger, So another question I have for you.
Sure.
With anything, there are some, I'd say, disadvantages or downsides, to it. There are some things one has to be careful of. Somebody's, in the mid 30s, early 30s, even, late 30s, they're interested in this. What are some of the things people have to be cautious about or should be at least knowledgeable about going into this type of policy?
That's a great question. And that's kind of where I come back to the idea of, everyone should know about them. They were a primary place for people to save all the way up until 401k started and stuff like that. Everyone should know about them. Almost everybody should implement. So what are some of the reasons that would cause a person to be one of those folks where maybe they shouldn't implement? Because what are some of the catches, like you're saying, right? Mm-hmm. Because it's wrapped inside life insurance, there is a cost. So, you have to be aware of that cost and just understand this thing is not magic, right? So coming into it thinking it's magic, wow, I have this place for cash where I can earn tax-free interest and leverage it into property. That all sounds well and good, but it's not magic. It's wrapped inside life insurance. So there's a cost to the life insurance. So we just have to be aware of the costs. Quite frankly, when I mentioned to you the first couple of years of a policy being the sensitive ones, what you're trying to do is you're trying to overcome the insurance costs and build up the critical mass of cash value inside the policy so it can effectively carry itself as its own business, so to speak. Being aware of what that takes in said policy, whatever size it is just something that prevents the person from having a curveball thrown at them, right? And definitely strips away it's not magic, but it works really well. So knowing the costs is just something you have to be aware of. Knowing that for any dollar of death benefit, because this thing is wrapped in life insurance, even though we're not trying to use it primarily for that, it's going to look more expensive than term insurance. And there's technical reasons as to why. Nothing, right. And I'll even say right here, nothing's inherently wrong with term insurance. Quite frankly, when you get into any type of insurance need or desire to have from a life insurance perspective, it's very difficult to solve that entirely with whole life. So there's always going to be a role for term insurance. But what some people can find is if they're trying to satisfy an insurance need, they can either do that with pure cost, which is term insurance, or they can start to piece some of that with permanent insurance and technically save money over time, keep more capital in their world. So, you have to be aware. So I'm coming back to that. What should people be aware of? You have to be aware of dollar for dollar of insurance. It's going to cost more, but that's effectively why we try to squish down the death benefit on a whole life policy. Another thing is, you're definitely going to need a couple grand a year to make a meaningful policy. So that could be the equivalent of, if you're in your 30s, $300 to $500 on the low end of per month if you go monthly to make a meaningful policy. And I say that because if you're saying it's a business that you want to leverage into real estate, you have to be pushing cash into it, right? So one of the concerns is if we know we have a couple grand and we can count on that for the next couple of years to push into this thing strategically, we're going to insulate ourselves from any type of hiccups. But if there's anything that could impact our ability to fund it, like wrecking your car and then having to spend money, like your story right earlier, right? Like then you would want to pause and make sure you handle that and then get back up to the point where you had that capital, because your policy can go sideways if you feed it once and then never have the ability to feed it what you were planning on feeding it for a few years. It can actually, the cost can kind of eat itself. And I don't want that for anybody, because that's when people have bad experiences and they don't like the asset anymore. So, knowing that there's a cost, knowing that you got to feed it for a few years and being aware of what it looks like and having the capability to do it, those are the things that effectively insulate someone from having a negative experience and quite frankly, then help them build an asset that's on the books, And one last thing, I get this a lot from real estate investors, you're not borrowing against the death benefit, you're borrowing against your equity, right? Very similar to property. You have a $300,000 property and the bank already, has 80% mortgage. You already have an 80% mortgage against it, loan to value. You can't go borrowing against the full house, right? They're not going to let you. There's a very similar analogy with life insurance. The death benefit is, your equity is basically the cash value, not the death benefit. So if the death benefit is 300, but your equity is 30, it's the cash value is 30 inside there that you've been building up and growing. That's what you're borrowing against, right? And because of the costs in the beginning, you put in $5,000 in year one, you're not going to have access to the full $5,000 because of those costs. So just being aware of that and then building that up over time.
Gotcha. And I think it's definitely worth, continuing to reiterate, you're borrowing against the cash value and you're not borrowing from the cash value. You're borrowing against it. Speak to the difference of when we say you're borrowing against it versus when you borrow. Because originally I thought you were borrowing from it, but you made it plain to me and I get it now. You're borrowing against it.
Yeah, and I'm glad you brought up that distinction. You definitely picked that up from our conversations. There's a difference in those words, right? Borrowing against means creating an asset, a loan against an asset or against your equity. So it's technically a different thing. So your equity is untouched and the loan is leveraging that asset. Taking from, so I'll say taking from would be the equivalent of having a bank account and removing money from it. The biggest difference is when you borrow against, you're not interrupting the ability for that asset, the pure asset that you're leveraged against, you're not interrupting the ability for that to continue to increase.
Right.
When you take from, you're physically removing money from an account and is no longer any interest there. There's not anything wrong with either of those approaches. And quite frankly, with a policy, you could take from your policy. It's just because of the way that the contract works, you can't always push it back in as easy as a bank account. So what you do is you borrow against it, and then you have the free will to basically cycle dollars into projects. It's not that you can't take from your policy. It's just very strategic, especially in the building years, Nick, especially like between now and when you're in your 60s. Leverage against this thing, keep buying assets outside of it while the cash continues to expand. And then the strategy is, I think I mentioned to you even off our call here, I spend a lot of time with folks who are in retirement who wish they had these accounts. They can still get them when they're in their 60s, but they wish they built them when they were 30 and 40 years old because of how valuable they are. And if they had one at that point, they could then, not necessarily, they could still borrow against it if they wanted to, but they could actually start withdrawing the dividends and withdrawing the cash value. And it's one of the only accounts, if it's built the right way, you actually get to take, as a tax word, you get to take your contributions, your basis out first. So if you had been building this thing for 10, 20, 30 years, and let's just say you have 100 grand of contributions in it, and it's growing to 200 grand of cash value, and it has a life insurance wrapped around it, the first 100 grand you take out, you would be literally taking out tax-free. And then when the next dollar would be taxable, you could start borrowing against again, and the loans are tax-free because they're loans. And then 20 years later, you kick the bucket, everything gets wiped, no taxes are owed. It's a really strategic asset. And that's the big difference between against and from. And it's very valuable to use the borrow against while we're accumulating, while we're building.
Right.
If that makes sense.
Right. And I wanted to bring that up because I remember, again, I was working for local municipality. We had a retirement account. It was a 403B, at that time. And I wanted to buy a property. I had about 15 to 20 grand in this retirement account. May have been a little bit more. And they had a borrowing arm or option with it, but you were borrowing from it. So I took the available funds, and most of the time they're going to cap you on how much you can even borrow from it. So say, for instance, it was 30 grand. If it was 30 grand, we'll just say 30 grand for an even number. Most of the time they're going to cap you at 50%. So I was only able to borrow 15, but when I borrowed that 15, those funds actually got deducted from my account. Those funds actually were deducted. They were not in play. They were not, in the market anymore, so they weren't growing, they were taken out. Of course, they allow, if it would have went through, it would have allowed me to purchase the property, but they were not in that account anymore. And that's a big distinction between, your traditional, retirement accounts, even your IRAs, Roth IRAs. Some of them allow some borrowing against or borrowing from, but you're taking them from that account. And I definitely was attracted. I think that's a big factor that people need to, be cognizant of when, if you pursue some interest in this type of, life insurance policy.
Totally, Nick. I mean, you bring up a really valuable point, and buried inside of that is a couple things. My takeaways and how it's landed on me. Number one, knowing that you could technically borrow from a retirement account could be helpful for a real estate developer. Could be helpful for a real estate investor because you have access to a couple dollars. It's 50% up to $50,000 of the balance, whichever is larger. That's how it works. So, but to your point, very, very importantly to your point, you're literally removing it from working inside that account, right? So now it's no longer getting whatever you would expect that account to do because it's out working for you somewhere else. So number one, so big takeaway is make sure you're putting it to good use, right? If you do it. But built inside of that story also is you're immediately put on a 5-year payment plan that's immediately deducted from your paycheck, right? That if you change jobs after that point, it's immediately due to be paid back in full. So there's some very nuanced terms that puts a cash flow crunch on an investor who wants to do that. That doesn't mean don't do it, but it also means you got to be aware of these terms. Now let's come back over to this asset that an investor's been building strategically right next to their bank account. And that's the whole life policy with the cash value. When you borrow against that whole life policy, they don't ask you for your credit score. They don't ask you for what you're using the money for. You do have to sign a piece of paper, and it talks about how there's an interest rate that's going to be assessed against the dollars outstanding, but you're not amortized over a period of time. Nothing. All you tell them is, do you want them to mail you a check or direct deposit the check? That's it. And then you've done this, I've done this, clients have done this. That's it, right? It's now your responsibility. And Nelson Nash talks about this, and Patrick talks about it a lot too in their books. It's your responsibility to have a plan, especially while you're building wealth, to pay that back strategically. So that could be a tenant paying you monthly and you're directing some of it to the policy loan. That could be floating the loan for 6 months while you're renovating and then refining out or selling. But you have a plan, but you're not put on a cash flow crunch. It's not magic. There's still math to it, but there's a big difference. And the asset continues to grow inside the policy while you're leveraging again. So it becomes a strategic thing for an investor. Not that one place of capital is better than the other, right? But having another place of capital where maybe they're not put on a cash flow crunch, or maybe the terms are more in their favor, becomes an incredibly valuable asset. That's what we've experienced, right?
Right. No, 100%. And even another use of it, we're specifically talking about real estate, but this factors into real estate as well. Quite candidly, my credit cards have gotten a little higher than I like them right now because just doing various things and doing projects and investing in some coaching and just various things. So credit cards are a little higher than I typically would like them. But another option that people don't realize that you could have with this, once you've built some cash value, now you can start refinancing some of that high interest debt. You take a 25% credit card and knock that down to 5%. That's huge.
Yep.
That's huge. And you start refining and getting that stuff out. I mean, you can really knock those and really recycling the money. You pay off one, get one paid down, pay that back through your loan, and you keep going with the next one. And that's definitely beneficial as well.
I'll add to what you just said there, and I think this is another way you can take a word and expand on it. So with a policy loan, I'm going to stick with the word loan, but I'm also going to just say we should stretch ourselves to think it's more like a line of credit. Right. With a policy loan, many times when we think of a loan, whether it's like a student loan or a mortgage loan or a personal loan, you're put on terms. And if you pay back things faster, you're knocking down the principal, but you're not changing next month's payment, one. And number two, let's say you knock down a personal loan or a student loan from 30 down to 20 because you've been throwing extra at it, and then a deal gets dropped in your lap, and you go back over to the bank and you're like, hey, bank, I've been paying you all this money for the last 2-3 years. I need like 10 more grand. Can you just like throw me back some of that? And they're like, no. And by the way, send us your $1,000 next month. That, the word loan usually refers to very structured terms. Even though it is called a policy loan, it is entirely like a line of credit, right? And without an actual requirement to cash flow back immediately. And I say that because if you, using your example, let's say you take a 20% plus credit card and you've been they've been asking for $800 a month, and you refi that out with a policy loan. So you take a policy loan, hit your bank account. This is the mechanics. You take a policy loan, hit your bank account, you send that to the credit card company, get them off your back. You could now not make a payment and your interest rate is 20 down to 4, and that's in your favor. Or you could, like Nelson Nash, I pick up his Infinite Banking book here, at the very least be paying a 5% calculation to yourself. But at the very most, continue to send that $800 a month that you were sending a credit card to your policy loan. Now, here's the difference though. Over here, the majority of that was going to interest. Some of it's principal, but you have the 20% interest on it. Over here, the interest is a quarter of what it was with the credit card. And anything additional is knocking down principal immediately that you have the right to, like a line of credit, request another loan, no questions asked when you need it, right? So you're throwing extra money at a bank loan, they're not going to give you that back, when you jump on an opportunity. Doesn't mean those are bad, but it's just a different term. Over here, you're throwing extra money at a policy loan, opportunity drops on your lap, you make another request for a policy loan and you're jumping on it. So very different.
And that's huge. That is huge.
Huge.
Man, you mentioned, that you've dealt with some people You have another arm of what you're doing now. You're dealing with older, people kind of entering into that retirement phase of life. And, you've heard several of them say they wish they would have established this, when they were younger. They wish they would have they wish they would have known about it, in their, 20s, 30s, even 40s, some of them. But as you age, of course, some people start having health challenges, things like that, or even some younger people, have some health challenges. And again, this is life insurance. So, they're going to come and they have to do a physical exam of you and just various things. How can a person that still is interested in this, but may have some health challenges, how could they potentially benefit from this?
What a great question. And I'll start with a joke, and you'll appreciate this from being near Chicago. I obviously appreciate this from being near Philly and New York. But life insurance does have a health component to it. And the insurance company is going to want to check your health, like you said, with an exam or with questions and possibly with the medical exam and stuff. And the joke goes like this. What's the difference between a life insurance actuary, that's the people that check the health, and a mob boss? And the answer is the life insurance actuary will tell you how many people are going to die next year because that's their job. The mob boss will give you their names, right? So it's like that's the and being from Philly, and near New York, I mean, I always just appreciate that goofy dumb life insurance joke. But there's a truth to the fact that you have to be insurable. And quite frankly, as we get older, Nick, every single time we go to the doctor, there's an opportunity for us to not be insurable again.
Yeah.
I don't mean that to scare anybody, but it is just literally the way it works. I was being for a medical procedure I had once. I was being wheeled into the office, and the guy who was pushing me knew about this concept. He's like, "Wow, you do that?" He said, "I love this because every time someone goes under, they may come out uninsurable the next time." I'm like, "You're absolutely right." Like it's like so incredibly important for us to take advantage of good health if we have it. But what if we don't? Is your question, right? Mm-hmm. What if we don't? What if we're, first of all, the best way to find out if you're insurable is just to let the insurance company do their homework, right? Because surprisingly, there are things that doctors treat us for that the insurance company is like, hey, that's being treated, no big deal. So there are people that are just like, I don't think I'm going to get it, but they end up coming back in good health. And there's different levels of pricing inside insurance. Like you have your good health, then you have your very good health and very, very good health. And then you have a couple levels just underneath good that still are okay, right? So there's part of my advice is let an insurance company do their homework. But let's continue to go down that story that you were asking about, which is what if they do their homework and it doesn't make sense for you? Like the pricing is just too high because you would be too much of a medical risk for the insurance company. Number one, it's good that you know that now because maybe that'll motivate you to fix something if it's fixable.
Right.
Right. But I'm also going to understand not all of it is fixable. So I'm not like trying to preach there, but sometimes that's motivational. But then secondly, insurance policies are contracts. And insurance policies have an owner, have an insured, and have a beneficiary. And I say that very specifically because you can own a policy that's not on yourself. You can own a policy, and I'll use this word even though there's nuances to it. You can borrow the insurability of a family member and still build a really nice policy that's meaningful to you and your family. So that could be now you have to have insurable interest. You can't just I can't take a policy out on you, Nick, and you can't take one out on me. It has to be either within your family unit or it has to be within a business entity, right? There has to be an insurable interest, it's called, and I won't even go down that rabbit hole too far, but it has to be somebody typically in your family or in your business. And if it makes sense, you could build and use policy the same way we've been talking about this entire podcast. You can build it on someone else, but have full control of it, right? And the health thing becomes just a non-issue or an easily overcomable obstacle, if that makes sense.
Gotcha. No, and I definitely wanted to, bring that out because, to be for real, there are people that do have some health challenges,
correct,
out there, but that does not mean you should stop or use that obstacle as a brick wall, because you got grandchildren, and not only that, this is how you start creating generational wealth as well. Think about if you put this type of policy in your, 17 or 18-year-old grandchild's name, how many years of building and accumulating that policy will be, when they get just in their 30s.
Lord willing, that's right. That's right.
Totally. So this is key, and I definitely wanted to bring that out.
Well, two things. Can I add to your statement right there, just with some nuances or some evidence? I meant to say, I'll say it right here. The number one purchaser of whole life insurance in America year over year is banks.
Really?
Number one purchaser. Patrick talked about it in his book. You'll find if there's another book I'll mention. Patrick talks about it in his book, Heads I Win, Tails You Lose. We have plenty of it on ParadigmLife.net's website, resources there where you can dig into some of this. And the book, Pirates of Manhattan, which is well worth reading. You got to be ready for a lot of data. But Pirates of Manhattan rips into the fact that banks are the number one purchaser. It's on their books. You can go right on the FDIC website and see it. What they do is they build it into executive comp packages because it's considered tier one capital, and they're only allowed to have money, like they have to hold while they fractionally lend and do all their banking magic. That's actually magic. Whole life insurance is not magic. Banking is actually magic, right? When they're forced not to lend out multiples of every single dollar, they have to hold some capital, which is called tier one capital, has very strict requirements as to where it can be held, has to be dependable, has to be strong grade. Life insurance cash value satisfies the requirements for tier one capital, and they hold a technical term crap ton of cash value inside cash value life insurance. And you can find it not only just in books, but right on the FDIC website. That's number one. Secondly, you talked about intergenerational, the big dog. First of all, these type of accounts were almost in everyone's household before the 401k. People saved in real estate, they saved in banks, and they saved inside cash value life insurance policies, because before the 401k became a thing in the 70s, that's what people did. Real estate, that's what we're talking about, cash and cash value. Then Wall Street pulled some dollars their way with 401ks, but it was still very strategically used for folks from a tax perspective for a long time, and still continues to this day. But I'll add to the intergenerational thing you said earlier, the big families that universities are named after, that have had generations of family wealth gone, they strategically use real estate, investments, and life insurance to handle some of that. I go like this because it's from generation to generation. It dumps a bucket. It's usable while that generation's alive, and then it dumps a bucket of tax-free cash into the next generation to continue to fulfill the family mission. So the evidence has been there for a really long time. That's some of what compelled me just on a personal level to implement this for my family. When I first read about this stuff in 2006, I was like, yeah, I want a little bit of that. I want a little bit of that stuff, and start to build from there. And it's been so dependable since. So hope that helps.
Garrett Gunderson wrote a book, What Would the Rockefellers Do? I don't know if you've read that one.
That's right. It's on the shelf. It's on the shelf over here.
And in that book, he outlines the difference between the Rockefellers and the Vanderbilts.
That's right.
Because during that period, both of them were the wealthiest families in the country. But we still know about the Rockefellers because their wealth has been preserved, but the Vanderbilts, we don't hear about them anymore. And the Rockefellers preserved their wealth through these policies, these type of policies. And then they also set up trust, family trust for it. And it's interesting when we talk about that generational wealth dynamic with life insurance being a part of it. Man, we're wrapping up on time. I told you I would not keep you too long. We're coming to a close. But some of our famous, I would say, more well-known financial advisors, like your Susie Ormans, your Dave Ramseys, if you listen to their commentary, they rip into whole life insurance. They don't talk highly of it at all. As far as an investment, what would be your rebuttal to Susie Orman and Dave Ramsey if you were able to have a conversation with them? Or would you even rebuttal them?
Well, yeah, we probably wouldn't get along from a where we're coming back from a principled standpoint, but their messaging works for some folks.
Right.
But and I'll give Dave some credit, helping people think about cash flow and debt. That's one thing. I mean, I almost drive off the road though when he says, "Oh, you're going to get 14% average in your mutual fund. You'll be rich in 10 years." And I'm like, how is he getting away with saying this stuff? But so I'm not trying. I don't throw the baby out with the bathwater, but at the same time, I'm very aware of what they do. And here's where I'm going with that. They both run businesses where they have messaging that speaks to some people, and they want to be edgy. I think it's important to look. And so their messaging is on brand with whatever they're saying, but they're driving a business with that message, right? Professionally, I'm going to say that message is appropriate for some people, but there's a large swath of people that would be throwing the baby out with bathwater. Keep in mind, Susie Orman, when she went from being like she's a hustler, worked hard, but when in the 80s, she went from just being like a waitress to working in financial services. She worked and promoted heavily single pay life insurance for very well-to-do doctors and business owners to help them shelter money from taxes. So it's really interesting that it's for business purposes. I'm confident her business, it's not ideal for her business to promote life insurance because she wants people to move into the market-based stuff. But it's really interesting that she knows the value of this historically because she made a lot of money, working with it in the early days. On Dave Ramsey's side, I think it's important for people to know he does what? He beats up whole life insurance and cash value life insurance, but he promotes the crap out of term and invest the difference, right? Mm-hmm. And he also promotes, paying down your mortgage as fast as you can and this and that. And a real estate investor would, sit on the same side of the table as me and say, there's a value to using good debt, right? It's really interesting to see that Dave Ramsey owns and has a part in a term insurance company that, of course, his messaging promotes, people to head towards that direction, and then he would get the benefits of any type of premiums going that route. So it's unfortunate. My big takeaway would be that advice. Unfortunately, I've come to find is very short. And I'll lean right back on a comment that I made earlier, Nick, that I said a lot of everyone should know about whole life insurance. Almost everyone should implement it. If one of those reasons not to implement is that a person just has those voices in their head and those people have said whole life insurance is an utter waste or like it's the devil, well, then don't use it. Like, I'm not here to tell you any different. Like, go run, down that message, down that path. But I know from my experience that it's short-sighted. It's short-sighted to say that this is a terrible asset has a proven track record, that has very contractual things that are in our benefit, very good tax provisions. It's short-sighted to throw that out and not investigate how it can be used. So that's kind of what will be happening inside the room if I was in there with those two. And, who knows if it would get heated or not.
Who knows? Well, Bryan, I definitely want to thank you for your time. It has been a joy and a pleasure. You've added a tremendous value, and I even learned some stuff today, and we've been working together now 6-7 years. So definitely appreciate it. To all my listeners, thank you again. This is episode 14 here at the Wealth and Real Estate Development W.I.R.E.D podcast, where we build wealthy communities, wealthy families, and wealthy individuals through real estate development. Again, it has been my pleasure. Hope to see you guys on the next episode. Thanks, and let's go get wired up.
Love it.
Thank you so much for listening to today's episode. If you enjoyed it, please share this content with someone else who would benefit from it. I'm looking forward to having you with me on the next episode. Now go out and create some wealth and real estate development.